Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now it's been an eventful week, to say the least, with major central banks making policy decisions and revising their economic projections. Perhaps most significantly, we of course moved past the quarterly Fed meeting, where the Fed of course both cut policy rates and revised its economic projections. Now the next step for investors, of course, is to understand what are the key implications, particularly of the Fed rate cut and the economic figures, and really how should investors, position their portfolios in response to, what we've heard from the Fed and the market reaction. So to discuss that and more, today I'm very happy to be joined by Raymond Cheng, who's our Chief Investment Officer for North Asia. So welcome, Raymond. Maybe let's kick off with the Fed. So we've just got a 25 basis point rate cut. What are your top takeaways from Fed Chair Powell's comments and indeed the dot plot?
Hi, Manpreet. What's notable about this Fed rate cut and Powell's comments is the clear shift in focus away from inflation towards supporting the U.S. job market, which Fed Chair Powell characterized as no longer solid. Now, having said that, he seemed to be keen to make a fine balance between supporting growth, which argues for aggressive cuts, and avoiding a jump in inflation expectations, which argues for a more cautious approach to easing policy. Therefore, Fed Chair Powell carefully characterized this week's rate cut as a risk management cut. Now, looking ahead, we agree with the dot plot, which now signals additional rate cuts of 50 bips to 3.75% before this year end, bringing the policy rate closer to the own long-term estimate of 3% neutral rate as it seeks to extend policy insurance amid still soft labor market data. Now, for next year, the Fed assumes only one rate cut of 25 bips. Now, that is mainly supported by the Fed's updated summary of economic projections, which raised GDP growth forecasts while lowering unemployment rate projections by 0.1% to 4.4% next year.
Thanks, Ray. Now, arguably, a Fed rate cut improves the chances of the U.S. economy achieving a soft landing, and that's usually support further upside in U.S. equities and the tech sector in particular, which has been doing very well year to date. Given what you described with the Fed, do you still expect growth momentum to sustain in both U.S. equities more broadly and the tech sector in particular?
Yeah, as markets normalize from excessively dovish Fed expectations, equity markets may be vulnerable to a pullback. But we would expect such pullback to be quite shallow, as further rate cuts should prove supportive of extending the growth and equity upcycle in the long term. That said, in light of valuation, we believe investors should rotate out of excessive exposures from the US to Asia ex-Japan equities, which can benefit from a weak US dollar on rate cuts. Now, on a sectoral basis, though, we remain constructive on the US tech sector fundamentally. The continued upward revision of the capex trend by hyperscalers on AI-related investments adds upside to earnings forecasts for both this year and next. Going forward, we need to monitor the progress of US-China trade negotiation and further developments on advanced chip export sales. Now, also, as our technical indicators show possible near-term consolidation in the communication services sector in the US, we would suggest adding to related exposures as well on pullback.
All right, let's move to bond markets. I think bond market reaction to the Fed cut was interesting, where yields moved initially lower in the minutes after the decision and then started to move higher. In your view, are bond yields now attractive in context of the Fed rate cut?
Yeah, we expect a near-term rebound in U.S. government bond yields. Now, market expectations for Fed rate cuts seem to have aligned with the Fed for this year. But for next year, the market expectation was a lot more aggressive than the one rate cut embedded in the median Fed dot plot projection. Now, this expectation gap poses a risk of a rebound in the 10-year and 30-year U.S. bond yields in the short term. For now, we would take profit on long maturity bond exposures and we balance towards our preferred 5 to 7 year maturity profile. Now, we anticipate a rebound in the US 10-year bond yield trust resistance level in the 4.2 to 4.3% range. And the US 30-year bond yields more likely trust the 4.8 to 4.9% range. And these are the levels we consider attractive to reconsider adding back to longer maturity government bonds. Now, as for US dollar corporate bonds, the Fed rate cut does not change our view that corporate bonds are likely to perform broadly in line with US government bonds, moves in which remain the dominant driver of yield and returns. The Fed decision to deliver a risk management cut supports our view of a soft landing scenario in the US, which is positive for corporate bonds. We expect corporate bond yield premiums to remain well anchored around today's admittedly tight levels, despite a heavy primary issuance supply pipeline. Now, all in all, Fed rate cuts will directly pose downward pressure to cash yield, so we prefer investing in bonds to cash at these levels.
Thanks, Raymond. I think that last point is particularly interesting as the implication for cash yield is something that's often overlooked in the rate cutting environment. Let's shift gears to the currency market. What about the US dollar? Is that likely to weaken after the Fed? And do you see any implications perhaps for major pairs like the euro dollar?
The lower interest rates, right, do reduce the yield advantage of US dollar denominated assets, raising risks of capital outflows. In contrast, the euro is showing signs of resilience. Rate cuts are not on the ECB's immediate horizon, and the resulting narrow rate differential supports the euro. Improving business sentiment and economic stabilization in Germany are adding to the bullish momentum. And we now anticipate euro US dollar to continue to trade around the 100-day moving average and test resistance at around 1.20.
All right. And very quickly in the time available, maybe a final question on going back to equities in Asia. So we had some weak economic data prints in August out of China. How does that impact your view on Chinese equities?
Yeah, recent monthly data they indicate continued weakness in China's growth momentum, as you said. Deflationary pressures persisted, coupled with decelerating retail sales and industrial production growth. In response, Chinese authorities have been bolstering policies to boost spending, including the recent package of measures comprising 19 items in 5 areas to bolster service consumption. We remain overweight on China equities over the next 6 to 12 months, with a preference towards growth areas such as technology, communication, and discretionary, supported by technological innovation and government policies. From the technical standpoint, we suggest adding to Hang Seng Index on pullbacks at the support levels of 25,800 followed by 24,500.
Okay, well, thanks very much, Raymond. We'll bring the conversation to an end there. Thanks so much for taking the time to speak with us today. If I can summarize the top takeaways from today's conversation, number one, following the Fed, we are still constructive on U.S. technology sector equities in particular. Would be happy to add, particularly on pullbacks. Second is U.S. bond yields, of course, could move a little higher in the very short term, but this may be an opportunity to move to a more moderate 5 to 7 year duration. And third, in an environment of dollar weakness or weak dollar rather, euro is likely to test 120. So we'll end the conversation there. Thanks so much for taking the time to listen to us today. We hope you enjoyed the conversation, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.